Welcome to the Skilled MBA Finance Case Study Series, where we explore real-world ventures that embody financial innovation, strategic thinking, and long-term value creation. Instacart has redefined the grocery shopping experience by building a digital platform that connects customers with personal shoppers. Its business model generates revenue through delivery and service fees, advertising, and strategic partnerships with leading retailers. As Instacart prepared for its initial public offering, investors and analysts faced a complex valuation challenge. How should they price a platform business that combines elements of gig work, retail logistics, and tech-enabled growth? This case explores the drivers of Instacart's IPO valuation, focusing on core financial metrics such as gross order volume, unit economics, and contribution margin. It also considers less tangible but equally critical factors: platform scalability, customer retention, and the strength of network effects that deepen the moat around Instacart's ecosystem. Understanding how a platform monetizes both sides of its marketplace is key to projecting future profitability. This case invites students to critically assess whether Instacart's growth trajectory and market positioning justify its proposed share price, and what risks may temper that outlook. Instacart's business model leverages a platform connecting customers with personal shoppers, generating revenue through delivery fees, service fees, and partnerships with retailers. Understanding these dynamics is crucial for evaluating its initial public offering valuation, as they directly impact financial projections and investor interest. In 2024, Instacart's IPO presents a valuation challenge. Maya Martinez, an investment banking analyst, must develop financial models to set the IPO share price. The key is balancing market conditions, company performance, and investor appetite to determine the optimal valuation. Instacart operates as a tech-enabled logistics platform, efficiently linking consumers with grocery retailers. Its revenue streams include commissions from retailers, delivery fees, subscription services, and advertising. As a market leader in online grocery delivery, Instacart is consistently broadening its service categories to maintain its competitive edge. Instacart's revenue surged during COVID-19, driven by increased demand for online grocery delivery. As the market stabilized, growth became more sustainable. Recently, Instacart achieved profitability, marking a significant milestone after years of financial losses. This shift underscores the company's ability to adapt and thrive in a post-pandemic economy. Instacart's key performance indicators are pivotal for IPO valuation. With 32 million active users in major Indian metros and 85,000 retail partners, the platform shows robust engagement. The average order value is 2,200 rupees, growing annually, while a 68% retention rate highlights customer loyalty. These metrics inform growth projections and customer acquisition costs. Maya should utilize various valuation methodologies. The discounted cash flow approach involves forecasting future cash flows and applying a suitable discount rate, though profitability uncertainty poses challenges. Comparable company analysis requires careful peer group selection, using enterprise value over revenue, enterprise value over earnings before interest, taxes, depreciation and amortization, and price over earnings ratios. Precedent transaction multiples consider recent mergers and acquisitions and initial public offering activities, focusing on control premiums and market timing. The DCF valuation model involves projecting free cash flows over 5 to 10 years and calculating a terminal value. Key assumptions include a 22% revenue compound annual growth rate from 2024 to 2029, and earnings before interest, taxes, depreciation, and amortization margin rising to 15% by 2029, a weighted average cost of capital of 12.5%, and a terminal growth rate of 3%. Sensitivity analysis highlights the impact of growth rate assumptions, margin expansion timelines, and discount rate selections Maya needs to evaluate Instacart's comparables by analyzing enterprise value over revenue and enterprise value over earnings, before interest, taxes, depreciation, and amortization multiples. Zomato and DoorDash show high multiples, indicating robust growth. Swiggy and Blinkit, with not meaningful earnings before interest, taxes, depreciation, and amortization, suggest early-stage dynamics. Big Basket's lower multiples reflect mature growth. The Indian market's unique factors further complicate peer selection, requiring careful consideration of business models and profitability. Rising interest rates are compressing tech valuations, while inflation pressures are curbing consumer spending. Recent tech initial public offerings show mixed performance, highlighting the importance of a clear path to profitability. Timing is crucial as market sentiment can quickly change, influencing investor interest in growth-focused tech initial public offerings. Setting the initial public offering price is a delicate balance. Overpricing risks a stock price drop, harming investor sentiment. The Goldilocks zone ensures fair value, appealing to investors and supporting long-term stability. Underpricing, however, can lead to a missed capital opportunity, causing dissatisfaction among pre-initial public offering shareholders. Investment banks aim for a successful offering with robust investor demand and stable aftermarket performance. Instacart focuses on maximizing capital raised and ensuring strong post-initial public offering performance. Venture investors seek maximum valuation and liquidity, while public investors desire an attractive entry price with upside potential. Maya must balance these interests while maintaining financial analysis integrity. Applying diverse valuation frameworks is crucial for determining a comprehensive initial public offering valuation for high-growth tech firms. Integrating qualitative market conditions with quantitative analysis enhances accuracy. Understanding market dynamics, including investor sentiment and timing, is vital. Effective stakeholder management involves balancing interests of company executives, venture investors, and public shareholders to ensure a successful initial public offering. IPO pricing requires a blend of financial analysis and market intuition. Valuation is multidimensional. Triangulation is crucial as no single method suffices. The growth versus profitability narrative must resonate with market sentiment. Sustainable positioning is key, ensuring the IPO price supports long-term market perception beyond initial performance. Instacart's IPO pricing strategy involves a complex interplay of financial analysis and market intuition. The valuation process requires triangulating multiple methodologies to capture a comprehensive picture. The narrative must balance growth and profitability, aligning with market sentiment. Sustainable positioning is crucial, ensuring the IPO price supports long-term market perception beyond initial performance. Thank you for exploring this finance-driven case with Skilled MBA. For more practical insights and case study videos, mobile +91-87553-00795, email support@skilledmba.com, website https://skilledmba.com